Tom Lee says it plain and simple. AI stocks are not in a bubble, it is the next tech revolution. Welcome back to the channel. Today we start with a short clip of Tom Lee from Fundstrat on CNBC where he breaks down why he thinks AI is just getting started, and why some stocks still make sense right now. I will play the clip for you, then I will walk you through my reaction and explain what he really means for investors. After that, I will go deep on 3 AI stocks I think are worth buying today, and why they fit into the story Tom laid out. If you only watch one video today, make sure this is the one you watch all the way to the end. If you find value, hit the like button. Let us get 1,000 likes on this one. Share the video with people who care about tech and investing, and drop your thoughts in the comments below. Subscribe so you do not miss the next important market update. Alright, let us watch Tom Lee and then break it down.
So the market obviously assumes that this is all going to happen, the government's going to reopen, and we're just going to get back on our merry way in the stock market. That's certainly what the trade says today. Am I right?
Yeah, I think there's a certain measure of relief because the shutdown robbed us of visibility on the macro data, and of course there's economic hit and there's suffering because air traffic is slowing. So I think for many reasons, I think this shutdown was a problem for investors.
So what about now between now and the end of the year? It's the AI trade that really seems to be debated. How do you feel about it heading into this final stretch?
I think it's still in really good shape fundamentally. We know there's a lot of visibility for AI spending, and we know there's still innovation and gain of function taking place with the models. So to me, it makes sense that there's still a payoff coming. I think one of the issues that investors are going to grapple with is, even though they may say AI stocks are expensive, NVIDIA still only trades at 29 times forward earnings. I mean, it's still cheaper than Costco, so it's hardly a bubble valuation.
No, but I don't think when they talk about the valuation of AI stocks, they're necessarily talking about NVIDIA. I think you would agree with me on that. They're more so talking about names like Palantir and some others where you could easily say, yes, their earnings have been great and the story's incredible, but at some point you're only willing to pay X for a stock, and maybe that one's gotten a little bit too rich, using that as an example of the kind of names they're talking about.
Yeah, I mean, I think Palantir is an example of what they call like an N=1 company. You've got a founder-led business developing products that really seem like magic for the companies that adopt it. So, should this just be getting a softer multiple? I don't think so. And Palantir's opening up so many markets, and if it was a venture capital firm, they'd be getting potential carry for how they transform businesses. So to me, I think that this is still a market discovering how to define the valuation model for Palantir. But to me, that doesn't mean it's a bubble. People would have said that about Tesla in 2018 because it looked incredibly expensive, and the stock in Tesla has been a huge performer since then.
But what was last week about then, do you think, at its heart?
Well, I think at the heart is the market wobbles, and so when the market wobbles, people, two things. One is they start to take shots at the leaders, right? Because they try to take down the leaders, thinking that's what leads us down. But the second, it really highlights the grim reality that we're about to have a third year of double-digit gains. The S&P's up 80% over the past 3 years, and funds are measured on 3-year performance. Only 21% of fund managers are beating 80% over that 3-year period. It is one of the worst ever periods for fund managers. And so they'd rather see the market fall so that it falls to their performance level. I think what's more likely, of course, is the market follows a seasonal pattern, which means there's going to be a lot of chasing into year end.
Don't you have any concern at all about the level of money that these companies are spending on their build out, and now the new wrinkle of tapping the debt market rather substantially to help do it?
I mean, Scott, yes and no. I mean, AI is proving to be a scale game. It's not like you and I could start a garage and make a model competitive with OpenAI. We need to have scale and a lot of chips. That's really the model that was required for telecom infrastructure and for energy infrastructure and, of course, for internet infrastructure and even fiber. So it makes sense that a handful of players are really playing a big role. And just like in the energy system, there's 8 majors. Everybody spends money on the 8 majors, and the 8 majors pay a smaller ecosystem. So I think it makes sense that that's what's developing in the U.S., and of course it's leaving other countries in the dust.
Let's start with the first point Tom Lee discussed, which was the government shutdown. According to him, the shutdown didn't just pause parts of the economy, it also robbed investors of something very important, and that is visibility. Without access to key macroeconomic data, investors were flying blind. Tom explained that this uncertainty created frustration because economic indicators like jobs, inflation, and GDP reports help traders and institutions understand where the economy and interest rates might be heading. When that data is suddenly unavailable, the market loses its sense of direction, which often triggers volatility. Now that the government is reopening, Tom said investors are breathing a sigh of relief. Air travel and other sectors that slowed down during the shutdown are starting to recover. Economic activity is normalizing, and traders are optimistic that the market can now refocus on fundamentals. Next, the discussion shifted to one of the biggest themes of the year, artificial intelligence. Scott Wapner asked Tom about the AI trade heading into the final stretch of the year. Tom's take was clear and confident. He believes the AI sector is still in great shape fundamentally. He said there is strong visibility into future AI spending and continued innovation that keeps pushing the technology forward. In his view, the AI trend isn't just hype. There is still real progress being made with new models and real-world applications that justify investor enthusiasm. Tom also pushed back against the common claim that AI stocks are too expensive. He used Nvidia as an example, pointing out that it trades at about 29 times forward earnings, which is actually cheaper than Costco. In his words, that is hardly a bubble valuation. His point was that Nvidia's valuation makes sense when compared to its profitability and growth potential. The host then countered by saying that when people talk about AI stocks being overvalued, they are not usually referring to Nvidia. They are talking about companies like Palantir, which have impressive stories and solid earnings growth, but may be trading at levels that seem stretched. Tom responded by describing Palantir as what he calls an N=1 company. This means it is a unique, founder-driven business that creates products that almost feel magical to its customers. According to Tom, Palantir should not be viewed like a typical software company because its technology is transformational for the businesses that use it. He compared the current situation with Palantir to what people said about Tesla back in 2018. At that time, many investors thought Tesla was outrageously overvalued, but the company went on to become one of the best-performing stocks of the decade. Tom's message here was simple. Innovation stocks often look expensive before their full potential is realized. Investors who label them as bubbles too early might end up missing the next major opportunity. Then the conversation turned to the recent market volatility. Tom described it as a market wobble, which he said triggers two common reactions. First, investors start targeting market leaders, trying to pull them down because they believe those stocks lead the broader market lower. Second, he said it exposes an uncomfortable truth for professional fund managers. The S&P 500 has gained about 80% over the last 3 years, yet only about 21% of fund managers have managed to outperform that. It is one of the worst stretches for active managers in a long time. Tom explained that this has created a strange dynamic. Some fund managers would actually prefer to see the market fall because a drop would make their own performance look better in comparison. But he doesn't think that is the outcome we will get. Instead, he expects the market to follow its usual seasonal pattern, which means there could be more chasing into year-end as investors try to catch up on missed gains. The final part of the interview focused on concerns about how much money major AI companies are spending to build out their infrastructure. Many of these firms are also borrowing heavily to fund that growth, which some analysts see as a red flag. Tom acknowledged that the spending is significant but explained why it makes sense. AI, he said, is a scale game. It is not something two engineers can develop in a garage anymore. Competing with companies like OpenAI or Nvidia requires massive computing power, advanced chips, and large-scale data centers. Tom compared this phase of AI development to previous technological revolutions, such as telecom, energy, and the internet. In each of those cases, only a handful of dominant players had the resources to build the core infrastructure that everyone else depended on. He said AI is developing in the same way, with a few major companies taking the lead and creating an ecosystem around them. Just like the energy sector has its 8 global majors, the AI industry is forming its own group of leading firms, and the rest of the market is positioning around them. He also noted that this leadership is leaving other countries behind. The United States is setting the pace in AI infrastructure and innovation, while much of the world is struggling to keep up. It is not just a technology race anymore. It is also about global economic influence and competitiveness. In summary, Tom Lee's interview was a mix of optimism and realism. He believes the reopening of the government will bring stability, that AI still has a long runway ahead, and that even though valuations and debt levels are high, these companies are building the backbone of the next technological era. he views recent volatility as normal market behavior and expects a possible rally into year-end driven by fund managers chasing performance. My takeaway from this interview is that Tom Lee's optimism is rooted in logic rather than blind faith. He connects innovation cycles, investor psychology, and historical market patterns to explain why he thinks stocks still have room to run. Whether or not you agree with him, his perspective reminds us that markets reward innovation, patience, and conviction. If his outlook proves right, we could be looking at another strong finish to the year and potentially another leg higher as we move into the next phase of this market cycle. Before we dive into the 3 AI stocks to buy right now, this video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. First up is Advanced Micro Devices, ticker AMD, a company that's become a powerhouse in high-performance computing. Founded in 1969, AMD has a long history of innovation and competition in the semiconductor industry. While AI is often associated with software, none of it works without cutting-edge hardware. That's where AMD shines. Their processors and GPUs are the backbone of many AI systems, providing the necessary computational power to handle complex algorithms and massive data sets. For years, one company dominated AI hardware, but under Lisa Su, AMD has surged ahead, focusing on data centers and the cloud, exactly where AI needs the most power. Lisa Su's leadership has been transformative, turning AMD into a formidable competitor in the tech industry. Their EPYC server processors are now used by Amazon, Google, and Microsoft, offering top performance and energy efficiency. These processors are designed to handle the most demanding workloads, making them ideal for AI applications. But the real game changer is AMD's Instinct MI300X accelerator, designed for the massive memory and bandwidth demands of generative AI. This accelerator is built to handle the intensive computational requirements of training large AI models. Training models like GPT-4 requires hardware that can process huge amounts of data in parallel, and AMD's accelerators are built for that. These accelerators enable faster training times and more efficient data processing, which are critical for advancing AI technologies. The AI chip market is projected to be worth hundreds of billions in the next decade, and AMD doesn't need to be number one to win big. Just capturing a solid share means massive growth. Their strategic positioning in this market is a testament to their forward-thinking approach. Their acquisition of Xilinx adds programmable chips, FPGAs, to their lineup, letting them offer custom solutions for AI inference and expanding their reach. This acquisition enhances AMD's ability to provide versatile and adaptable hardware solutions. Financially, AMD's growth is impressive, but the real story is their future potential as AI demand explodes. Their financial health provides a strong foundation for continued innovation and market expansion. They're investing heavily in software support, like their ROCm platform, to make their chips easy for developers to use. This investment in software ensures that their hardware can be seamlessly integrated into various AI applications. The risks, fierce competition, and the need to keep innovating. The semiconductor industry is highly competitive, and staying ahead requires constant innovation and strategic planning. But Lisa Su's team has a track record of flawless execution. Their ability to consistently deliver high-quality products and meet market demands is a significant advantage. AMD's reach goes beyond data centers. AI is coming to PCs, cars, and smartphones, and AMD is already there with Ryzen CPUs featuring integrated AI engines. These processors bring AI capabilities to everyday devices, enhancing their functionality and performance. This is a multi-pronged growth story. More AI means more demand for AMD's processors everywhere. As AI becomes more pervasive, the demand for AMD's hardware will continue to grow. Their strong balance sheet and reinvestment in R&D create a flywheel effect. Success breeds more innovation. This cycle of innovation and success positions AMD for long-term growth. In the short term, the stock may be volatile, but the long-term thesis is clear. AMD is selling the essential picks and shovels for the AI gold rush. Their products are fundamental to the development and deployment of AI technologies. They've broken a monopoly, fostered competition, and positioned themselves as a high-performance alternative. This competitive edge is crucial in a rapidly evolving market. For investors, it's a chance to own a key player in the infrastructure powering AI's future. Investing in AMD means investing in the backbone of the AI revolution. The more AI grows, the more AMD stands to benefit. Their products are integral to the advancement of AI technologies. Their diverse portfolio, CPUs, GPUs, FPGAs, gives them a unique edge in meeting the varied needs of the AI market. This diversity allows them to cater to a wide range of applications and industries. That's why AMD is my first pick. Their strategic positioning and innovative products make them a compelling choice for investors. Proven leadership, a strong roadmap, and exposure to the fastest-growing segment in tech make it a compelling buy. AMD's future looks bright as they continue to innovate and expand their market presence. AMD carries a market cap of approximately $387.91 billion. Its P/E ratio sits at about 125.41, and for 2024 the company reported earnings per share of $1.90. Revenue for that year reached $25.78 billion, and net income was $1.64 billion. These metrics already show growth, but what makes AMD truly compelling today is its momentum in AI infrastructure. The company recently forecast strong fourth-quarter revenue ahead of estimates, driven by accelerating demand for its AI chips and data center offerings. That combination of high valuation and high growth in a sector with enormous runway is what positions AMD as a high-potential buy in the AI tech stack. If you want to invest in the backbone of artificial intelligence, AMD is a core holding. Their products are essential to the development and deployment of AI technologies. The AI revolution is just getting started, and AMD is right at the heart of it. Their momentum is undeniable. The opportunity is massive. As AI continues to grow, so will AMD's influence and market share. Don't overlook AMD in your AI investment strategy. Their strategic positioning and innovative products make them a key player in the AI market. Let's move to the next company. Next up is Meta Platforms, ticker META. Yes, the company behind Facebook, Instagram, and WhatsApp, but also a quiet AI powerhouse. While most people know Meta for its social media dominance, what's less obvious is just how deeply AI is woven into the company's DNA. Meta isn't just riding the AI wave, it's been building it from the ground up. Meta has been an AI-first company for years, using machine learning to power everything from your newsfeed to ad targeting. Every time you scroll, like, or share, AI is working behind the scenes, personalizing your experience and optimizing what you see. Their secret weapons? A massive trove of proprietary data and a world-class AI research team, responsible for breakthroughs like the PyTorch framework. PyTorch, now a staple in the global AI community, was born at Meta and is used by researchers and companies everywhere to build the next generation of AI models. While others are scrambling to catch up, Meta has been building AI infrastructure and talent for over a decade. Their investment in custom hardware, data centers, and research labs has given them a head start that's hard to match. Their boldest move, open-sourcing their Llama large language models, has sent shockwaves through the tech world. By making these powerful AI tools available to developers worldwide, Meta is shaping the future of open-source AI and democratizing access to cutting-edge technology. This strategy accelerates innovation, builds a huge developer community, and positions Meta's technology as the foundation of open-source AI. It's a play to make Meta indispensable to the next wave of AI startups and researchers. As Llama becomes more widely adopted, Meta gains influence and valuable feedback, improving their own products. The more developers use Llama, the smarter and more robust Meta's AI ecosystem becomes, creating a virtuous cycle of improvement. Meta is integrating generative AI into all its apps. Think AI assistants in WhatsApp, creative tools in Instagram, and smarter ad targeting. These features aren't just flashy add-ons, they're designed to keep users engaged and advertisers happy. More engagement means more ad revenue, and better AI means more value for advertisers. Meta's ability to deliver highly targeted, effective ads is a direct result of its AI leadership, and that's a huge competitive advantage. Then there's the metaverse. While Reality Labs has been costly, AI is the key to creating realistic, interactive virtual worlds. Meta's vision for the metaverse isn't just about VR headsets, it's about building a new digital economy powered by AI-driven experiences. Meta's AI research powers everything from photorealistic avatars to generative 3D content, tying their AI and metaverse ambitions together. Imagine virtual spaces that feel alive, with AI-driven characters and environments that adapt to you in real time. If AR/VR becomes the next computing platform, Meta could own the operating system of the future. That's a bet with enormous upside, and Meta is positioning itself to be at the center of it all. Financially, Meta is a cash machine. After streamlining operations, profitability soared, and the company is now lean and focused. Their year of efficiency wasn't just a slogan, it was a turning point that made Meta more resilient and agile. The market still values Meta, mainly as a social media ad business, underestimating its AI and metaverse potential. This creates a unique opportunity for investors who see the bigger picture. you get a dominant ad business plus two massive call options, AI and the metaverse, essentially for free. It's rare to find a company with this much upside and so many ways to win. Risks, regulation, and the possibility that the metaverse bet doesn't pay off. There's always uncertainty when you're pushing the boundaries of technology and society, but even if it doesn't, Meta remains a leader in digital advertising and AI. Their core business is so strong that even a partial success in AI or the metaverse could be transformative. Their infrastructure, talent, and open source strategy make them a fundamental creator of AI, not just a user. Meta is helping set the standards and tools that the entire industry will use for years to come. The Llama strategy could reshape the AI landscape in Meta's favor. By empowering developers and startups, Meta is building an ecosystem that could rival any closed platform. Meta is willing to invest aggressively in the future, and their AI leadership is a major asset. Few companies have the resources, vision, and technical depth to compete at this level. The combination of a profitable core, AI innovation, and a bold vision makes Meta a compelling investment. It's a rare blend of stability and explosive potential. You're betting on Zuckerberg's vision and Meta's ability to execute at scale. The company's track record of pivoting and thriving in new tech eras speaks for itself. AI is the engine for Meta's future, and they're holding a powerful set of keys. The next decade could see Meta transform not just social media, but the entire digital landscape. With a market cap of roughly $1.56 trillion, a P/E ratio near 27.44, and earnings per share of $22.62 for 2024, Meta is huge. In that same year, revenue hit $164.5 billion, and net income tallied $62.36 billion. These are big numbers, and they show that Meta isn't just a social media company anymore. It is now a major player in AI, infrastructure and ad monetization at scale. With its massive user ecosystem, deep investment in AI models and infrastructure, and the balance sheet to back it up, Meta gives investors a way to play the AI revolution through a multifaceted growth engine. That's why Meta is my second pick. It's a company with the scale, ambition, and technical firepower to shape the future of AI and beyond. Don't let the metaverse headlines distract you from Meta's real AI advantage. The company's true strength lies in its relentless innovation and ability to adapt. The upside is huge if they're even partially right. Meta's bets on AI and the metaverse could pay off in ways we can't yet imagine. Let's look at our final company. Our third pick is Microsoft, ticker MSFT, the enterprise tech giant that's become the platform and distribution leader in AI. Over the past decade, Microsoft has quietly transformed itself from a legacy software company into a powerhouse at the center of the AI revolution, leveraging its scale, reach, and relentless innovation. Microsoft's strategy is simple but ambitious. Infuse AI into every product and service, from Office to Azure to Windows. This isn't just about adding a few smart features. It's about fundamentally reimagining how people and businesses interact with technology, making AI an invisible but essential layer across the entire Microsoft ecosystem. Their partnership and investment in OpenAI gave them exclusive access to the world's leading AI models, putting Azure at the forefront of generative AI. This move wasn't just strategic. It was visionary, giving Microsoft a unique edge as the world races to adopt next-generation AI tools. While competitors scrambled to catch up, Azure became the go-to platform for developers and enterprises eager to build on the best AI tech. Microsoft's early bet on AI infrastructure is now paying off, as more organizations choose Azure for its reliability, security, and access to cutting-edge models. But Microsoft didn't stop there. They integrated AI into their entire product suite. From productivity to security, every Microsoft app is getting smarter, more intuitive, and more powerful, creating a seamless experience for users across devices and platforms. Enter Copilot, AI assistants in Word, Excel, PowerPoint, Outlook, and Teams, helping users work smarter and faster. Copilot isn't just a chatbot, it's a productivity revolution, automating routine tasks, generating content, and providing insights in real time. This isn't a future promise, it's a product available now, with huge monetization potential. Businesses are already paying a premium for Copilot, and as its capabilities grow, so does its value proposition. With hundreds of millions of Microsoft 365 users, even modest Copilot adoption means billions in new, high-margin revenue. The scale is staggering. Microsoft can drive growth simply by upselling AI features to its existing customer base. Microsoft's distribution advantage is massive. They already have the customers, making AI adoption seamless. Enterprises trust Microsoft, and that trust translates into rapid deployment and stickiness for new AI-powered solutions. Beyond Office, AI is powering Bing, Dynamics 365, and even Windows, making the whole ecosystem smarter and stickier. Microsoft is weaving AI into every corner of its business, ensuring that users and enterprises alike benefit from the latest advancements. Azure, the world's #2 cloud, is growing fast thanks to AI, and Microsoft is investing billions in custom AI chips to optimize performance and control costs. These investments are about more than just speed. They're about building a sustainable, scalable AI infrastructure for the future. They're thinking about the entire AI stack, from foundational models to the silicon they run on. By controlling more of the stack, Microsoft can innovate faster, reduce dependencies, and deliver better value to customers. Financially, Microsoft is a fortress, pristine balance sheet, huge free cash flow, and a history of rewarding shareholders. Its financial strength gives it the flexibility to invest aggressively in AI while still returning capital to investors. Risks: antitrust scrutiny and fierce competition from Google and Amazon, but Microsoft's deep enterprise relationships and high switching costs make it hard to dislodge. The company is navigating regulatory challenges with experience and a focus on responsible AI. The more users adopt Copilot, the better the models get, creating a virtuous cycle that reinforces Microsoft's leadership. Every interaction helps improve the AI, making the platform more valuable over time. Microsoft is playing the long game, leveraging its strengths to capture AI's value across cloud, software, and developer tools. Its investments in GitHub, LinkedIn, and other platforms further expand its reach into the developer and enterprise communities. For investors, it's the perfect anchor for an AI portfolio, broad exposure, with the safety of a blue-chip giant. Microsoft's diversified business model and proven track record make it a reliable choice in a rapidly evolving sector. They win if enterprises adopt AI, if developers build on Azure, and through their stake in OpenAI. No matter which part of the AI value chain grows fastest, Microsoft is positioned to benefit. Satya Nadella's transformation of Microsoft has been remarkable, turning a legacy giant into an AI leader. His vision and leadership have re-energized the company, making it more agile, innovative, and future-focused than ever before. The vision is clear, execution is strong, and the financials are starting to reflect AI's impact. Microsoft's quarterly results are already showing the early benefits of its AI investments, with more upside ahead. Microsoft is the stable anchor you want in your AI portfolio. It offers both growth potential and downside protection, a rare combination in today's tech landscape. It's a bet on the digitization of the global economy with AI as the catalyst. As businesses everywhere modernize, Microsoft stands to benefit from every stage of the transformation. That's why Microsoft is my third and final pick. It's not just about today's products, but about a company that's shaping the future of technology. Microsoft's market cap sits at about $3.73 trillion, its PE ratio around 35.75, and in 2024, the company reported earnings per share of $14.07. Revenue for the year came in at $245.12 billion, and net income was $88.13 billion. With Microsoft, you're getting a company that sits at the heart of enterprise software, cloud infrastructure, productivity tools, and AI deployment. It is leveraging its partnerships and ecosystem to turn artificial intelligence from hype into recurring revenue. For investors seeking a more safe route into AI, one with strong fundamentals and diversified exposure, Microsoft offers a compelling mix of scale, profitability, and growth potential. If you want broad, safe exposure to AI's biggest trends, Microsoft is the way to go. It's a company that's proven it can adapt, innovate, and lead through every major tech shift. The opportunity is just beginning. We're still in the early innings of the AI era, and Microsoft is positioned to be a winner for years to come. Don't miss out on Microsoft's AI transformation. The next wave of growth is already underway, and Microsoft is leading the charge. Let's wrap up with your next move. Now's the time to consider how Microsoft fits into your AI investment strategy. So, there you have it, 3 companies, each with a unique strategy to dominate the AI landscape. AMD gives you exposure to the compute and hardware backbone. Meta leads in open-source AI and digital worlds. The company Meta gives you exposure to platforms, user scale, data, and AI-driven monetization. And Microsoft gives you exposure to software, cloud, enterprise applications, and arguably the smoothest path to durable revenue from AI. Each offers a compelling way to invest in the most important tech shift of our generation. Each of them brings different strengths, different risks, and different opportunities, but all 3 sit squarely in the path of what many believe will be the next major technology transformation. Remember, think long-term and understand the story behind each stock. For more analysis and exclusive picks, check out the StocksGalore Patreon. Which company's AI strategy do you think will win the next decade? Let me know in the comments. Thanks for watching. Don't forget to like, comment, and subscribe.